Hello, welcome back. A subscriber of the channel asked me to make a video about Intuit. We were having a discussion about it on Discord. And I always pay attention to what people ask me to analyze because I understand that there is some interest about these companies. And it makes sense. Intuit is a very, very well known company. I was actually living in California for quite a few years, and the company was pretty much there. And it's a company that I have used their software, TurboTax, in the past. And as you can see here, they have been performing rather well. But recently, with the rest of the stock market and the tech companies as well, have been going down. That's something to be expected. Yet they did have some explosive growth in the previous years. And so I want to discover whether it makes sense to buy now. And because the stock actually went down like 35% or so, year to date that is, that doesn't mean that we are automatically buying the company. And you may have been familiar with this type of investing when something goes down and people are telling you that you need to buy because it's cheap. But the fact that it went down doesn't mean it's cheap. Nowhere near that. We need to determine whether it's cheap by analyzing the company and the financials of the company, and that's how we do it as careful investors. Otherwise, we are basically buying a lottery ticket and we are hoping it will turn out to make us some money, and that's not the way to invest again. So let's take a look at what the company is doing. The company is actually paying dividends here, as you can see, a little bit, 0.6. And it's worth noting that they're paying 0.6% in dividends, yet their payout ratio is 33%, and that's very high for the percentage that they are paying, which tells me that their profit may not be good enough to sustain paying dividends for a long time, or at least paying dividends that are increased. So they may stay at a similar level, but if this becomes 1.2%. then we're looking at a much higher, like double payout ratio here. Although as you can see in the payout history, at least they have been increasing every year. Yet I would be relatively scared about this figure at 0.6% again, because this figure, generally speaking, is a good figure. But typically you see companies that pay like 2 or 3% to having this payout ratio, not 0.6. So that's a little bit of a concern. That's worth investigating potentially if you are thinking of owning the stock. Now, you obviously probably don't really own the stock for the dividends. You probably own it for the growth, or at least that's the idea for a company like Intuit, I suppose. Yet, in order to validate that, we need to be taking a look at what the company is doing in terms of their growth. And so you will see here that the company does enjoy some growth. It's not explosive growth, although the last 12 months have been amazing for the company in 2021. So this is explosive growth, especially this one. And what about the net income of the company? From less than $1 billion to 2.1. Some good growth here, but nothing insane. It's growth to be expected, I suppose. And it's still good, of course. The balance sheet of the company is looking at total liabilities of almost 11 billion here, and total equity of 16 billion, which is more than the total liabilities. This is a good thing, of course. And the cash flow of the company, we will notice that keeps increasing as well, and steadily increasing. I kind of like this steady increase year over year. It's a good thing. It resonates with me. The cash from investing, the company is actually acquiring companies here. It looks like they made some acquisitions, and you will see here that they're actually selling securities here. This is sold because it's a positive number, so they sold some securities. I guess that was a good thing to do, based on what we're seeing from the markets. And the thing that I actually forgot to take a look at was the outstanding shares here, how much they are growing or decreasing. So they are actually growing lately. So the company, took some advantage of the increasing stock prices. As the board, as the director of a company, this is probably what you have to be doing. But as an investor, you don't really like it so much, because you're getting diluted. I guess it's not an insane increase, and actually the company in 2013 actually had more outstanding shares than they have now. So overall, I'm probably fine with that one. And let's go back to our cash flow statement here. Okay. And we were looking at the financing, and it's actually positive in the last 12 months because the company has been selling some shares, as we saw, some investments. And they are repurchasing some common stock though, as I can see here in the last 12 months again. So good to see. They also issued debt. So the company issued quite some debt here, 4.7 billion, and they did have their last issuance of debt, which was 3 billion in 2020. Okay, that's not necessarily bad, of course, because companies that make good cash flow, they can and probably should issue some debt because they can use it as leverage for growing. So that's not a bad thing at all. Don't be scared about companies getting debt. Free cash flow of 1.5 billion here in 2017, but right now sitting at 3.2 in 2021 and 3.1 almost in the last 12 months. So that's a good growth over here. On par with basically the growth that they had for net income. That's good to see, generally speaking. The multiples of the company are pretty high here. This is a very high multiple. So the enterprise value to sales is a very high multiple here. We typically want to see it below 3 or near 3. This means that the company is actually selling less than what it's worth. And it's a multiple of the enterprise value to sales here and the price to sales as well, which typically means that the price of the stock is elevated based on, if you actually compare it to what the company is making in terms of sales. So that's what we are looking at here. And so what a lower multiple, as low as possible, of course. The profitability of the company is sitting at return on equity at 18%, which is fine. It's not bad at all. Solvency 46.4, the total debt to equity. Now, the company has issued a little bit of shares. They do have a little bit of debt, but that's a normal figure. I'm not scared of that at all right now. The next thing that I want to see, and it's very, very important, it's at this current financial stature here, does it make sense to own the company? Its stock price is $424. So let's go to our tool here and use the projections tool that can actually tell us whether it's a good idea to buy the stock at its current valuation or what's a good price to pay. And you will see that we have a breakdown of the metrics of the company and a very, very quick and handy table here that can tell us what to use for our projections. And the idea is that we use this one, and then if we're a little bit unclear about some of the values, we go here and we see the full breakdown of the last 5 years. And so the revenue growth of the company has been at 15% for the last 5 years, 17 for the 3, and last year was actually 25, which is, as you can see here, it's basically their best year. And that's a good thing because we're having increasing revenues, of course. So I'm going to go with something like 13, 14, and 15 here, staying a little bit conservative still. I don't want to overdo it. And the net income margin is pretty much the same every year. And you can see here it's very, very similar every year. 18 was like the worst one, 23 was the best one, 24 almost. So that's great because we can actually project in an easier fashion here. And so we're gonna go with, let's go 19, 20, and 21, I think makes sense here. The free cash flow margin is pretty great here. It's pretty high, and their last one was 124. That's great. So let's go 110, 120, and 130 here. And the annual return that I like to aim for is 13% because I can make 10% out of an S&P 500 ETF. So I want to be making more money out of a single stock. More risk, more money to be made. Or at least that's what I want. So the calculation tool will tell me that the price of the stock right now is elevated based on what the company is worth. Again, based on these projections. And so even at the highest estimates, we're getting a company that should be trading at around $231 right now, yet it's almost double that. And so I ideally want to get companies at their lower estimates. And so this would mean that we'd have to have like a 60% decrease or so, 60 to 70% decrease or so in the price of Intuit in order for me to think about entering the company here. So that's probably like 60%, right? So right now, as the company is, and as the finances of the company are, it looks overvalued for my taste, and that's what the model is telling me. Now, I like what the company is doing. It's a good growth company, and especially the last few years, looks like they're doing well. They're increasing their revenues, increasing their net income and cash flow, but they are expensive right now. And that's very, very important, because we should be buying companies not only because they're great companies, that matters of course, but also because it's a great investment, because a company and a stock are two completely different things. And as cautious investors, our job is to actually marry these two things and find those companies that have stocks that are undervalued. That's what we want to do, and buy them and hold them for some time and then make money out of this. That's the idea. We don't want to be buying stocks that are overvalued, even if they are held, if they are backed by great companies, because then we have a limited uprise. So, yeah. Hopefully that helps you a little bit. Let me know if you liked the video by leaving a like below. That really helps. And consider becoming a subscriber if you aren't already, because eventually I'm gonna be giving this tool away to people. You will be able to access it probably in 2 or 3 months or so. I will be giving access, so you may want to stick around. And thank you for watching this one. And I have to thank our subscriber for, giving this suggestion. It's a very, very interesting company to take a look at, and thank you for that. And thank you for watching, guys. In the meantime, take a look at the video that I made earlier, and it is discussing Alibaba and the latest steep decline in the stock price, and why I had to buy more because of that. Thank you for watching. See you soon. Bye-bye.